Well, the markets continue to be rocky. There's a lot of jumping around, especially in commodities. A lot of news today. Today we heard from the Swiss National Bank, the Swiss central bank, if you will. They're raising a cap on their exchange rate. That has had a huge impact on gold. Oil continues to fall down and bounce around, and of course, copper is doing some pretty interesting things. So we're going to be talking to Bart Mellett quite a bit over the next few weeks, and he joins me now. He is the head of commodity strategy at TD Securities. Nice to see you.
Great to be here.
Okay, let's start off with gold. What's happening with gold today?
Well, we had the Swiss National Bank remove the cap on their currency. The implication is that the currency will likely move higher. But, you know, it goes beyond the Swiss currency. It basically refers to the expectations of quantitative easing. Whether that happens or not in Europe is an open question, but certainly the market may have interpreted this action from the Swiss National Bank as signaling some sort of large move on QE in Europe. That implies lower interest rates across the board.
Okay, and so then take this then into gold. So we saw gold moving up quite a bit today. So why is that happening?
Well, there are a myriad of reasons. Today's development is just the latest. To be very quick about it, number one, there is really no inflation in the world anywhere, and even in the United States, at a time where unemployment rate is dropping and has dropped quite sharply, there are very few pressures on prices. In fact, wages aren't moving up. So the market is deciding that it is very unlikely that the U.S. Central Bank, the Federal Reserve, will be in any hurry whatsoever to lift rates. Well, that means lower opportunity cost of holding gold. At the same time, we're expecting some sort of quantitative easing action from Europe. That implies, again, lower Bunds rates. That's the German interest rate on bonds, and probably a movement into treasuries for safety. That, again, implies lower rates, again, positive for gold. And if that wasn't enough, we're getting all sorts of turbulence in emerging markets, particularly in Russia. Russia is getting absolutely slammed on their currency, and there are concerns now that some companies in Russia may have difficulty paying their debt. Again, risk-off sentiment, and people are moving into gold in response. So very many variables moving gold up. And if that wasn't enough, we had some negative data on the retail side in the United States, which basically pushed us towards technical levels that were breached, and hence today's highs.
So the trends that are in place for gold, and again, you named 17 in the last minute, so there's a lot. Do you see those staying intact? And if so, for how long?
For the next little while, we think that gold does better. In fact, we ended up reversing ourselves. We were quite negative, thinking that the Federal Reserve will tighten sooner rather than later. Now we are no longer predisposed in thinking that. So we think this year will likely be a very good year for gold. Well, very good relative to last year anyway. We're looking at higher levels.
Okay. Let me ask you about, put gold aside for a moment, oil. Part of the reason we're seeing a lot of lack of concern about inflation, of course, is that oil prices come off so much, so that's going to bring inflation levels down. But the disorderly way, I will say, that oil has come off, the question is now low for how long? Do you have any sense of where we go from here?
Certainly. We think we don't go anywhere up for quite a time. I think, you know.
Are we talking months, years?
Quarters, probably not much over 50 for any time this year.
Okay.
We're looking at, for the next 6 months, around 40, somewhere around there. It will be certainly trading within a range between 45 and somewhat below 40, maybe a little higher, but no real impetus to move prices higher. And we would say that in the immediate future, over the next, weeks or few weeks, maybe a couple of months, probably a significant downside risk. There are a lot of long positions still that have to
downside from where we are right now.
Where we are right now. There are still a lot of long positions that have to be squared. Mm-hmm. We are in a contango, so people may not want to refund or re-enter their long positions. At the same time, we are having a war of attrition between producers. OPEC is steadfast at their levels. Russia is steadfast at theirs, and we're expecting maybe some 600,000 barrels of new production in the United States this year. So that means a surplus this quarter, maybe 1.5 million barrels. Same next quarter, and that easily translates into some 280, 300 million barrels of new inventory over the next 6 to 9 months, on top of significant increases in inventory last year. So too much oil, not enough demand.
Let me ask you in terms of, do you have a range? I know Goldman Sachs came out and had a 6-month target on oil for 39. They said, I think it was in the next 6 months. They said that a few weeks ago. Is that... Would you kind of say, could we swing around? Is this?
I think 40 is probably a reasonable level
Okay.
That we think will average. We might go a little below, a little above. That's a lot of noise. But
Yeah.
at a time where you are producing in excess of 1.5 million barrels a day for 6 months, basically implies that prices will have to go down at some point. Somewhere in the world, people will be faced with inventory constraints. Simply, they'll have no more room to put it.
Yeah.
And they're going to have to cut production.
We're hearing stories of tankers. I mean, out in the water holding oil and those kinds of things as well.
And that is happening. And as more and more tankers get engaged, the cost of engaging them will rise. And that means that you're going to have to, net back it to the producer, and at some point you'll hit a price which will force some producers to stop. We're not seeing that yet.
It's interesting to see what that price will be. We will have to stay tuned. Copper, the final one that I wanted to touch on today. Dr. Copper with a PhD in economics. It's a cliche, but it's a cliche for a reason, because it's often a good indicator for growth. Concerning copper now, what, at a 6-year low?
Something like that, and copper hasn't done particularly well this year. It's dropped particularly sharply yesterday, and the reason is not a huge mystery. Is we're quite worried about global poor performance, and particularly we're worried about Chinese economic growth.
Right.
We are forecasting surpluses in 2015. We had a surplus in 2014, and we had a significant surplus in 2013 as well. So there is plenty of above ground inventory of copper. We're expecting more build this year, and it stands to reason why people may not want to pay too much money for something that's in a situation of a surplus.
So we're going to be, again, the copper, looking out, if you were to give an idea for what you guys are planning for, it's staying low for a while?
I think it's staying low through much of this quarter, and we would think it starts picking up slowly in the second quarter. We're going to get a lot of volatility, but another driver of copper has been oil. It's been reducing the cost of getting the stuff out of the ground.
So reducing the cost of copper producers to get the copper out.
That's correct.
Yeah.
And the sky-high U.S. dollar is also reducing costs in U.S. dollar terms. So all those factors are playing against copper right now.
I've got about 30 seconds here, but I want to ask, in amongst all this, are there any bright spots in the commodities? What commodities look interesting or attractive at the levels right now?
Well, we've already mentioned gold.
Yeah, yeah.
And I would say beyond the second half, we're really like platinum.
Yeah.
And we continue to think palladium has a considerable upside. Supply is short. All we need is some economic growth, particularly from Europe, to re-energize that market.
I think a lot of people would like that for a whole lot of reasons. Bart, thanks so much.
My pleasure. Thank you.
Bart Melek, he's head of commodity strategy at TD Securities. I'm Kim Parlee. Thanks so much for watching.